Holy smokers, folks, this ain't no dang jokers. We got a buy one, get 3 free here today, folks, okay? 4 videos for me to react to. I even brought a drink for this one. Honestly, I should have probably brought a pizza too or something because, I mean, this is going to be a beast one here today, folks. First one up here I'm going to react to. NASDAQ's rip higher looks like a bear market rally from 3 hours ago. I want to hear what they have to say and react to that one in this one, okay? Next video up here from 8 hours ago. Inflation will have a very dramatic drops over the next few months. I want to hear that. That's an important subject not enough people are talking about. Everybody wants to talk about, how high CPI has been in the past, but no one's talking about what's going to happen over this next 3 to 6 months. And I'm like, well, why do we want to debate everything in the market, but not debate what's happening with inflation? Like, this is the biggest subject, let's not forget, for the market over the past year, right? Third video we're going to react to. This one's actually from yesterday. I wanted to react to this one. Earnings will soon drive equity markets. And so we'll react to that one. I'm going to give my opinion there. And this one from 10 hours ago. The upside for the markets is likely capped, okay? Let's hear what she has to say, and I'll give my opinions and perspectives on that. So once again, thank you everybody joining me. As always, 25,100 plus subscribers, I believe, on the channel now. I appreciate everybody that subscribed to the channel. Also, thank you everybody that supports the channel on Patreon. If you would like to support the channel on Patreon and get access to all the moves I'm making in the market, which I'm making moves tomorrow in the Patreon portfolio, and you want to see screenshots of everything I'm up to and whatnot, you can check that out. That's going to be pinned comment down there. Also, Discord chat is up and rolling now, so we got a Discord tier if you want to join that as well. I think we have 19 members in the Discord chat. I don't know what happened to my camera there, but if I recall, we got 19 members now in the Discord chat. So cool. Hopefully build out to maybe 50 or 100 members over time in there. Alrighty, guys, let's get into this.
I think we had the setup for a perfect bear market rally. You know, if you look at the TMT bubble aftermath, you had 4 market rallies after the market peaked in March 2000 that were on the order of 25 to 50% in the context of a downtrend. And so I think we can get into technical jargon of, is it a new bull market or bear market rally? But to me, new bull markets are formed when there's been regime changes, when fundamentals inflect positively, and we just haven't seen either of those. In fact, I think positioning into early in the year came real negative. If you look at the CFTC NASDAQ futures position, was very negative. The recession that everyone was widely anticipating didn't hit immediately. And then you had the second leg of this rally when you had a banking crisis. And oddly enough, or perversely enough, tech is being viewed as defensive rather than cyclical.
Yeah. I thought it was interesting, Chris, what you said there about how a new bull market requires new leadership. And Mike, obviously, we don't have new leadership. We have the prevailing leadership of the past decade. Would you also say that...
Hold your horse, okay? What are we talking about here? New leadership, like what's going to take over in that situation, right? I mean, the big dogs are still the big dogs. I mean, remember, a lot of these companies have so far to go with their business models. Basically, the point he's kind of trying to make is like new stocks need to be like the leaders and whatnot. I mean, some of these companies are still so early days in their profitability opportunities. Revenue opportunities, maybe they're further along, but as far as net income opportunities, like think about Amazon. Perfect example. Amazon's so young as a net income company. Amazon was still barely making break even if you go back 5-7 years ago. That company has a long runway of profitability over this next decade. And I believe that's one of the reasons Jeff Bezos stepped aside. I believe the gentleman that's leading the company now at this point in time is going to, obviously have that company perform in a tremendous way. Tesla just got profitable in the last couple of years, right? I mean, Apple just continues to grow bigger and bigger, especially with their services business. And people that break an iPhone go buy a new iPhone, right? And so you think about these opportunities. Microsoft's so sticky, so people just continue to sign up for them. They can go up every once in a while. I mean, you look at that old leadership, there's going to continue to be leadership. Meta, I mean, if you're going to advertise, you better advertise on Facebook, Instagram, WhatsApp. Like, that's where to advertise. So if you go through all these companies, it continues to be leadership. NVIDIA continues to tear it up, right? Like, these are companies that are still running the world and will run the world even more so over the next 5-10 years.
Have to make higher highs or new highs in order to say that we're on kind of a new bull trend, Mike?
Look, I think you could argue that, but if that were the case, then we weren't in a bull market from 2009 to 2013. Okay, we didn't make a new all-time high over that entire period of time. And some people will tell you, yeah, it sort of has to be tested, and then you retro date the start of the bull market if you want to do that. So I think that, the question really for me is, the NASDAQ 100 certainly could eventually prove itself to have been in a new bull market. I think it's more interesting to discuss, do the October lows look like they're going to be important? Are they going to be consequential? Are they going to be durable? And how much could you fall before you bring those that back into sight? And to me, that's where we are right now. It's not so much we're going to make an attack on the all-time highs. It's have we established a new range? And I agree with Chris, the positioning got very negative. It's happened multiple times coming into the year. But that also means that people had over-anticipated bad things, whether it was an imminent recession or whether it was the Fed going to become more hawkish than expected. So the downside that we got to because of the negative positioning was also an overshoot in the short term.
And would you agree with that, Chris? And where does that then leave us set up for the next quarter?
I think the big change in factors was Fed liquidity. And we found a very strong correlation between the Fed balance sheet reserves that they have and report each weekly. We'll get the update after the close today, and the NASDAQ. And I think there was a turn in Fed liquidity in the beginning of the year, and certainly that accelerated in the last couple of weeks, and that's put an upward bid on the NASDAQ. And so I think it's been all about the Fed. And you throw in these technical trading ranges and relative strength and highs and lows, and that matters too in positioning. But to me,
hold on, let's fact check this gentleman here for a moment, okay? I want to see, because if I recall, the NASDAQ actually hit like recent highs, if I recall, before the whole banking stuff and before that whole drama show unfolded and the Fed kind of reversed there, right? So let's pull up a 1 year of the NASDAQ. And yes, I mean, you know, if you go back here, we're February 2nd, we're sitting at NASDAQ 2100, higher than we are actually today, which is fascinating. So, you know, I think that point he just made there is not quite correct, factually, when you pull up a chart, right? So anyways, I thought that was worth mentioning.
The biggest turn and the reason the NASDAQ has performed as well as it hasn't been EPS revisions. In fact, you know, other than Meta and a few semis, EPS revisions from the start of the year have been down, not up. It's what's up between, you know, now and beginning of the year, Fed liquidity, you know, and that's and expectations that the Fed may cut in the back half of the year, and that's what's driven the NASDAQ.
That said, Chris, why aren't you more bullish? You know, because again, you say you're still bearish, see a relatively deep recession ahead as these Fed cuts hit. But if the liquidity underpinning is now turning, why are you not more bullish on that support kind of being something that stocks can ride higher?
So we're in a strange environment. The Fed's hiking and sort of cutting at the same time in a way, right, with adding liquidity and doing the opposite. And so our view is that what happened over the last couple of weeks is a seismic event. Bank credit is going to tighten. Companies are going to be under pressure. Tech spending is going to get cut. And in the end, tech is cyclical. And we're going to find that out over the next couple of quarters when all of a sudden companies start coming on the show and coming out with earnings release and saying things just abruptly stalled. And we have higher conviction in that now than we did even at the beginning of the year, because
tech companies already said that last year. All due respect to the gentleman, did you miss last year? Did you miss last year, sir? That's what every single tech company told us last year. Why do you think they're cutting thousands, tens of thousands of employees at every tech company out there? Holy smokes, sir. I think you must have been sleeping last year.
Credit is the lifeblood of the economy, and we're unwinding what I think is a 13-year zero interest rate tech spending bubble. So that's why we're cautious.
Very interesting. Mike, I was just going to give you a quick last word.
Yeah, I mean, I'm a little bit less focused on the kind of step-for-step move in liquidity as defined by what's going on in the Fed balance sheet and the overall market. The other thing to keep in mind is it sounds so right to say we were in a 13-year zero interest rate, you know, investment boom, but we actually had a tightening cycle in there. It was very stunted, but it got real interest rates up to about where they are right now in 2018, and the market did have a panic off of that. So I don't think it's been necessarily like some spigot that's been wide open since 2008, and we just closed it, and now we don't know what happens next.
All right, Michael Santoli, Chris Senek. Good stuff, guys. Thank you both.
All righty, next up here, inflation will have very dramatic drops over the next few months. Ooh, I'm excited for this one.
And co-founder of RS Asset Management, as well as a CNBC contributor. What are the cross currents? When you put them all together, you bullish or bearish, Carrie?
Well, I think it's a reasonably optimistic scenario. If you look at where we've gone with interest rates, we've had lots of raises. We know the Fed is most of the way through. On the inflation front, inflation has been coming down, not as fast as anyone wanted. But I think over the next couple of months, you're going to see some fairly dramatic drops in inflation because of housing, rent, and energy. The market understands that earnings for this past quarter, are not going to be great. I don't think expectations are high. And we're starting to see some stabilization in sectors like technology that are large and important to the market, and the companies are responding. You know, you've seen restructuring and efficiency moves, whether it's led by activists or managements don't like seeing their stocks down 70, 80%. So, if, you know, you put it together and assuming that there's no more shoes to drop on the banking side, you know, we perhaps stabilize there. We're in a better footing than we were, a week ago or 2 weeks ago. And if we're in a recession, let's get it on. You know, let's do this recession, and markets certainly bottom well before recessions have finished.
So you think that the interest rates being below where the Fed says they're going, do you think that they're sniffing out what you talked about with inflation? You think it is moderating at this point?
Yeah, I mean, if you look at the housing markets, that's definitely a factor, and energy prices have come down. The Fed has to keep their options open. They can't say we're done. They have to say, you know, we're vigilant and we're going to be data driven. They give you all the sound bites, which are necessary. But if we get to another month or two, you know, they're not going to do anything right until May. So we're going to have more data about inflation. And depending on that, you know, they can change their mind. No one is going to fault them if they say, we've seen a lot of improvement. Yeah. We're going to be on pause right now. And they've already warned that there might be a 25% increase next time. So yeah, we'll see what happens. But it's certainly
they're not increasing. That's all I got to say about that.
Less than what we've been through already.
What would lead us out of the doldrums that we've been in? If you do see maybe a landing of some type, you know, a mild recession, and you do see rates stop going up, what do you think would be the best place to put your money in terms of sectors?
You know, well, it's interesting. What we saw over the last 2 years is this huge run in energy. We would be suspicious of owning more energy right now just because of that dramatic move. Technology has been, you know, in the doghouse for 18 months, and it's still an important growing segment of the economy. And you know that those balance sheets are strong. They're going to grow.
Yeah, I don't agree with that. Technology was in the doghouse for 11 months. From basically the start, it was around November 2021 through October of 2022, technology was in the doghouse. But it's very self-explanatory. Pull up a chart of the NASDAQ, pull up a chart of the Qs, pull up a chart of any of the big tech stocks. Almost every single one of those stocks bottomed either in October or November and then started an uptrend from there. Okay. And so they, you know, let's not make out like they've still been in a doghouse. Like they've been out of the doghouse for, about literally almost 6 months now at this point in time. That's incredible to think about. Some of those, wow. And then a few others, they've been out of the doghouse for 9 months plus. Netflix comes to mind. Shop comes to mind. I think Shop bottomed before a lot of those other stocks bottomed. So that's something to keep in mind.
Earnings, even if they're modest compared to the last few years, but at least we've got market multiples for most of the big tech names and a desire to show some improvement in margins. So I think those large tech stocks can continue to move higher. You know, I've heard that people say they're overpriced, but, you know, Meta is still at market or below market multiple, as is Google, Apple in the low 20s. I mean, it's still one of the greatest companies that's ever been created. So if you get the balance sheet and growth cash flow, I
got 10 seconds.
Hey, don't shut her off.
7.
Oh man, they need to keep her going, man. She was getting point after point after point. I pick her to be the winner of the day. Holy smokers, okay, that was no joke. They should have just let her run for another 10 minutes there. She was killing them, okay. Next up here, earnings will soon drive equity markets. Let's hear what this gentleman has to say, and I'll react to that one and give my opinion.
Sticking with that view is...
And by the way, Meta is still easy money.
Motto. He's the president and chief investment officer of equities at Neuberger Berman. And Joe, welcome. This was a broad call by the firm just thinking that inflation was going to be pretty sticky and that as a result, the Fed would have to hike rates. But all of the things that we've seen happen in the financial industry to this point, the banking crisis, has a lot of market players betting the opposite at this point. There's tons of turmoil, not just in equities, but also if you look at the 2-year note. What do you think at this point?
Well, thanks for having me this morning. It certainly points to the challenge that the Fed has, right? Because it's got two challenges in front of it. First, the inflation issue, which you referenced, and our view has been that a number of the stickier components of inflation were going to be pretty resilient over the course of the year and probably end the year more in the 3.5 range than where market expectations have been, which is a bit more modest than that. Now, at the same time, of course, a few weeks ago, you had this financial stability issue, right? So the Fed's trying to compartmentalize these two challenges.
Dang, that's fascinating. You guys notice what I noticed? Almost the Dow is almost the same as it was pre-market when I reacted to that last video. That's wild. Back-to-back days. It's almost like, wait, is this the same day? No, it's 2 different days. It's crazy.
Dealing with inflation by continuing to raise rates, tighten financial conditions, but at the same time use other tools in the toolbox to deal with the situation that, of course, we all that exploded on the scenes a couple of weeks back. Our view is that I think the Fed, for all intents and purposes, the hiking cycle is coming to an end. We think they may go one more time. If it wasn't for, of course, the Silicon Valley issues, we think the Fed would probably have been more aggressive, but clearly they need.
I don't think they're going one more time. And why do I have the belief that they're not going to raise anymore and they're done now at this point in time? The reason is I think inflation is going to fall far faster than a lot of folks realize, especially over this next 3 to 6 months. And so what I believe is going to play out is I think you're going to see, us hit a mid-5 here, and then I think we're going to hit like a high 4. And from there, I think we're going to hit a mid-4, then a low 4. And so nonetheless, I think being that we're going to be on that trajectory and being that Fed funds rate is already roughly what we at 5 or so, I don't believe there's any need when the Fed's going to see CPIs coming down the way they need it to come down over this next, let's call it, few months here. So that's my belief there. We'll see what obviously transpires, but that's why I believe there's really no need. This was the last questionable one, right? I think it was almost a coin flip for the Fed to look at this past one, like, do we raise, do we not raise, what do we do here? And I think they were probably really, really close to not even raising this past meeting, but they decided to still go for it. I don't think they're going to make that same decision next time. That's my personal belief on that.
Pull back and slow that rate of tightening of financial conditions because, the market is doing it for them, right? Banks are going to pull back on lending given the situation that we're dealing with, and that's going to serve to do some of the Fed's job for them.
Joe, the weird thing is watching equities. You're still talking about the market up today. You're talking about the S&P right around the 4,000 level where it's been bouncing around. All of this bad news, everything from a banking crisis to the idea that companies are not going to be able to meet earnings expectations, has that all already been priced in?
It's pretty amazing. I mean, if you think about where we are today, we're about at the end of the quarter and stocks are up 3.5%, 4%, whatever. The fixed income markets, bonds are essentially up 3-ish%. So, it doesn't really demonstrate how volatile the quarter's been, as you said. The economy is proving to be pretty resilient, right? The consensus right now for the first quarter GDP is roughly in the 2.5 range. We're about to see first quarter earnings. Now, first quarter earnings, I think, are going to be an important determinant in terms of the next phase of where the market's going to go. Expectations right now are for first quarter to be down sort of mid-single digit percentages. Again, not that bad, and I think that's partly why the market's up. But I think when you think about the S&P 500, it really is two components, right? There is a half a dozen or so mega cap technology companies, right? They're up strong this year. They're up 20% in aggregate or so. The rest of the market is essentially flat for this year, right? The mega caps trade at 27, 28 times earnings, and the rest of the market's at 15, 16 times earnings. So it really shows the dichotomy when you're using the S&P as a broader market gauge.
Yeah, to take that a step further, okay, where do I see the most opportunities in this market? I don't see the best opportunities in the market necessarily being, the Apples and the Microsofts and many of those stocks. Although I'm not going to say those are bad investments, right? I'm sure you can make money over the next few years. But I think when you dive a layer or two deeper, that's when you really start to find real opportunities in the market, like much better risk reward profiles, in my opinion, if you're a longer term investor. I'm not talking for the next 3 to 5 months or the next 3 to 5 weeks. I'm talking the next 3 to 5 years. Much better risk reward profiles. And so that's the interesting thing in this market. You have a lot of stocks that are doing well at the very, very top, but beneath that, a lot of stocks are still just tremendous opportunities. Small caps continue to be phenomenal values out there across small cap land. Mid caps continue to be great values. And I think in order to get those smalls and those mids to get moving more, I think the one thing that's needed, in my opinion, certainty. More certainty before people really start to dive into those ones more. People don't mind, even in an uncertain market, putting money in Apple and Microsoft and some of those big dogs, right? But if you're talking about the smaller companies, that needs more certainty about what's going on with inflation, what's going on with the Fed, what's going on with the economy. As you can begin to, inflation become less of worries, the Fed raising becomes less of they're not raising anymore. If anything, they're getting closer to cutting, right? If you can start putting those pieces together, then those smalls and those mids can start to branch out, and those ones will start to obviously move up in a pretty significant way. That's when you start to really get back into a full bull market at that point in time. Just because a few stocks at the top are doing well, it doesn't mean you're on a bull market. For a true bull market to happen, you need the whole movement. You need the whole tree to be growing, okay? Not just one branch off the tree. You need 100 branches to grow off the tree. And I feel like right now we got like 1 or 2 branches that are really growing on the tree, and everything else is kind of still just waiting and seeing what's going to happen here.
Question is, would you be telling people to buy if you think the rate hike cycle is done, or like Mike Wilson has been out there saying that he thinks it's going to be the end of a bear market, but a pretty violent and painful one? Do you tell people to buy now or wait for better prices?
Well, we've been defensive. We've been underweight equities for a while. We've stayed consistent with that since early part of 22. I think
that's the other issue why this market can't. I'll let him finish and then I'll dive in here. But that's
shoe to drop, if you will, is earnings, and that's where I think the equity markets are going to be driven by. So we think the economy is going to slow. The actions of the Fed clearly have a lag effect. You now have these additional credit crunch challenges and potential risks. So the risks have increased, although, again, you're toward the end of the rate hike cycle. So, we've been advising clients to get ready. There is a point in time where you want to take more risk. It's just not there yet because we haven't seen earnings recalibrate down, which we expect over the course of the latter part of 23.
See, that's the reason, what you just watched there, that's the reason this market has had so much trouble going down on more scary headlines, banks failing, blah, 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 right? Because at the end of the day, so many of these folks already went so defensive in 2022. So many of these fund managers, these Wall Street folks, went so defensive. And now they're wondering, why is the market not dropping? Well, maybe it's because you all already went so defensive last year. And so at this point in time, it's like there's so much money just already chilling. Treasuries, just money in savings accounts. These folks have just money hiding out in different places, right? And at the end of the day, it's like in order to get a big sell-off, let's say a 10, 20% fall in the S&P, you need mass selling. You need people that haven't sold despite everything we've gone through to say, you know what, now I've got to get out. And so many of those folks already made that tough decision last year. And that's why you're having so much trouble. And I see this consistently. When these Wall Streeters go on CNBC, they talk about, we're defensive, we're positioned defensive, we're holding cash, we're in this sector that we feel is defensive, blah, 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 right? And so that's the interesting moment. It's not like these folks are all in Tesla and Meta and all these other stocks that are actually doing well. They're in defensive mode, and they're ultimately going to have to pile into a lot of these stocks over this next 6 to 12 months at much higher prices than they're even at today, which is going to be really intriguing because, it was one thing to buy Meta at 88 or 90 or 100. It's another thing to buy Meta at 250, 300. Yeah.
Range bound. Give us a little bit more direction when you say range bound. Right now, we're seeing the markets above 4,000. They've held pretty steady above 4,000. At one point this year, they were down to about 38.60. Are we going to dip back to that?
And here's the other issue. Oh, this is so important. This is such a good point I'm about to make here, okay? Is if you start getting any little drops in any of these stocks, these guys that are way underweight right now are going to be piling into those stocks on even small dips. Like I'm talking like 5%, 10% moves down in any of these stocks. They're going to pile in because they're already so off sides that they're like, crap, I need a position into the market. It reminds me of like if you're, let's say LA real estate, right? LA real estate always, for the past 50 plus years, been a great real estate market to be part of. One of the reasons prices hold so well in LA and go up is not just because you got a lot of people that live there and whatnot, and a lot of people that have money, but ultimately you have a lot of people that love to buy rental properties there, right? And are just looking at it from a place to park money. I want to buy another house, just a place to park money because it's LA real estate, right? And so it's so hard to get any massive drop in the LA real estate market because if there's any drops, people with money are there to buy that house. If you get if that house is at a 5% discount, oh my gosh, got to buy this baby, okay? And so that's just another important factor. Like if you see any little sell-offs in any of these stocks, believe me, these Wall Streeters that are way off sides right now are going to pile in and because they have to, because they're running out of time in the situation. And it's like they're so far off sides and they're looking and they're watching stocks go up and they're like, can we get some sort of dip here so I can position in?
60 or stay closer to this 4,000 range?
I think maybe dip down to 38.60. So I've actually been on this whole range-bound bandwagon pretty much since last June. So since last June, I thought, there's a lot of stuff that's gone on, a lot of information that needs to be consolidated, and that simply takes time to get through it. So we've moved. And it's interesting, actually, if you look at that range bound since June to now, you see the range consolidating, which actually makes me feel pretty good. And you all know I'm no technician. But I think what it really says from a fundamental perspective is that we have digested a ton of information. And it's interesting because I was having an argument/debate with my partner, Greg, the other day. And he said, look, I can make a really bullish case for the market, and went through all the things that could go right, which is earnings start to improve. China continues to reopen. We know where interest rates are going. We know that they're probably not going up too much more from here. And went through this whole list, and I said to him, okay, but what does that get you to? $240 earnings? Even if you stretch and put an 18 times multiple on $240 earnings for next year, you're still at only about $41.50, which is only about 7% upside. So I think the upside is really capped, and there's still a lot of difficult stuff.
To be fair, 7% upside in the S&P is quite a bit. It's not like it's a small amount here.
We get through. I think earnings aren't going to be just glossy and rosy from here. I think they're going to be bumpy. And so that's why I'm really...
At 7 percentage points in terms of, if you're talking about S&P 500, then you're talking NASDAQ up another 10%, 12%, because the NASDAQ's almost always on an up market. It's going to outperform the S&P 500. And then if you're talking about that sort of move, you're talking about countless stocks up 30, 40, 50, 60, 70%. Because, look at the move the NASDAQ's made and look at how many stocks are up 50 to 150% since then, right? So I think that's something important to kind of keep in mind.
Concept of range bound continuing.
Okay.
I think it just continues to be a battle of forces of good and evil.
So I want to bounce something off you. I know you're a big dividend investor. I want to show you something right now. We're looking at the SDOG ETF. This is an ETF that follows the dogs of the Dow strategy over a couple of different sectors. It's actually up this week pretty big, outperforming. What do you make of seeing this outperforming in a dividend-focused ETF when so many investors are turning to the bond market for yield, and sometimes higher yield than you can even get from a dividend?
Right. So I think it's interesting because if you look at that SDOG or if you look at DVY or any of the dividend indexes, they actually did really, really well in 2021 and 2022. They held up far better than the broader markets. And then they continued to hold up perfectly fine this year until SVB. And then what you saw was they all tanked, right? And they were down 10% kind of in 3 weeks. As a dividend investor, I got the same spanking that they did, so that stung. And it's interesting because I think you can claim that it has to do with rates, but it really doesn't, because what you saw was as rates were increasing in 2022 into the beginning of this year, they actually continued to hold up. So the real reason that they were down so severely, I think, is because by and large, dividend stocks are frequently energy stocks, regional banking stocks, companies with a lot of leverage, smaller capital stocks, and all of those what got really pummeled in that knee-jerk, fear response following the banking collapses, starting in the beginning of, starting March 10th. And so what happened now, and the reason we're seeing a recovery, is just that those positions were wildly.
All right, what we just learned, folks, is that S-Dog is crap, okay? It's underperformed. Literally the Dow Jones Industrial Average, every period I just ran it through, holy smokers, that was no joke. I was thinking at least there was going to be some periods when maybe it did better or something, hypothetically, but geez, yeah, not exactly a very attractive thing.
Oversold. I don't mean the ETFs, I mean the actual stocks that underlie the ETFs were wildly oversold due to nothing wrong with the individual companies, just this response in the market to sell off. Yeah, so I think it's oversold, now being bought back. I don't think it has to do with interest rates.
All right, Jen, we want to bounce a couple of things off you right now. We have some upgrades and downgrades this morning. We're going to start off with Evercore upgrading Walmart, boosting its rating to outperform from inline, also raising its price target to $160 from $145. It cites management's diligent work to pivot Walmart to an omni-channel operation and divestment of non-core assets. What's your take on this upgrade of Walmart?
So we've looked at Walmart many, many times over the years for our disciplined growth strategy and continue to hold off over and over because it's really expensive. We think that the low-end consumer may, if there is a broader economic recession, who's going to get hurt the most? It will be the lower-end consumer. That's where they benefit the most. That's, their main consumer. So we continue to hold off. I haven't read that report yet. Maybe there's something nuanced in there, but every time we've looked at Walmart, we just come away saying too expensive, not enough actual growth.
All right, we've been noting all morning futures in the green, tech's outperformance. What do you make of that? We've had so many disruptions. I know you think things are going to stay range bound, but obviously tech just continues to outperform.
Mm-hmm. I think it's played out. It's a lot of those stocks, Apple, Amazon, Google, Meta, they're just up. Nvidia, they're up 30, 60, 80% this year. And there was an interesting thing I heard on CNBC yesterday, which was those stocks on average are up 5% on the year, where on average, or rather, I'm sorry, those stocks are responsible for a 5% gain in the S&P 500, where the S&P 500 was only up yesterday 3.5%, which would imply that they've more than carried the weight. And I look at them and I see valuations that are not that cheap, and I see growth prospects that are not that compelling. So what I think happened, which they were the beneficiaries of the dividend stocks punishment or anything with leverage or anything small cap, where as soon as things got scary about a month ago, people ran for what had worked for them in the past without really saying, okay, Apple, you're trading at 25 times earnings, but you're only going to produce 6% earnings growth. That doesn't make sense. So I've never thought that those stocks should implode, but I've always thought that they should plateau. Their valuations are stretched relative to their growth prospects.
All right, so Meta, first off, you can't even argue that that's even close to being overvalued or plateauing or anything like that. No, okay? That's not even worth a debate. Apple, okay? Here's the deal with Apple. That company, damn it, that was a hard year. 2022 was vicious, let's be honest. Consumer confidence went to the lowest we've ever seen in history. China was locked down for part of the year. There was all that drama. Massive currency headwinds to Apple, right? Obviously, commodity pressures like everybody else faced. I mean, just a lot of things that they had to deal with as all companies. I gotta say, they weathered the storm way better than I thought. I'm amazed. I'm shocked. It was incredible, okay? And if you look at Apple's installed base, and I don't personally own Apple stock, but damn it, I gotta give them respect. You can't bet against that company. And at 25 times earnings for a company that, at the end of the day, people just upgrade their products and get the same products, the next generation iPhone, the next laptop, and the next MacBook, the next iPad, the next AirPods, whatever, right? And the services business gives it so much protection now. I mean, at the end of the day, until there's a real disruption, I was talking to a friend about this recently, and I said, until there's a disruption in smartphones and we go to some new form factor or something like that, I mean, it's hard to bet against Apple. That's why I can never bet against it. Even time periods when I'm like, oh, their earnings, it can't be good. It can't be good. And then they come in and somehow they meet expectations. How are you guys doing this? It's insane. But they're just that sort of company. Microsoft. I don't personally own Microsoft, but damn it, I got to give it to them. Like, they got one of the stickiest business models out there. Regardless if the economy's good, bad, okay, doesn't matter. Microsoft people are still going to be signed up for their services, their suite of products, and they're going to still put up their great numbers. And their cloud product is phenomenal. So, when you look at it from all these different angles, it's not like those stocks are really that expensive. And why doesn't Microsoft, for instance, deserve to trade at a 35 times multiple? There's countless companies I can tell you that trade in that range of 30 to 35 times. That when you've got that sort of sticky business model and you're kind of almost more of a, let's call it SaaS type business model, which is kind of what Microsoft is. But the most needed SaaS arguably out there, why shouldn't you trade at 30 times the market or at a 30 times multiple? So when you look at it from that standpoint, I mean, I don't know if I can really say those stocks are that expensive, especially when they're going to continue to grow EPS over the coming years. So I think from that standpoint, it's really hard to make a compelling case that those stocks are anything but a very good value. I think Amazon's going to have their net income explode over this next few years. Between the cuts I'm seeing Amazon do and the things that worked against their net income, I think their net income is going to go through the roof over this next few years. Is going to be extraordinary. I think of big tech, they'll probably be the strongest net income growth company of all of them by probably quite a margin. I think after that, you're probably looking at Meta for the strongest net income growth over the next, just looking at the next 3 years. I'm not talking about the next 10 years, just the next 3 years. I think Tesla will have an okay year this year. They might, if we make it through this without any sort of hard landing, then they could have a nice reacceleration of earnings growth in 2024, especially with Cybertrucks ramped up and rolling. Oh my gosh, okay. So that could be a really exciting time there, and they could definitely push up some major EPS growth and net income growth in regards to them. So I appreciate everybody joining me as always. I hope you get great value out of this channel. I appreciate you joining me. Thanks for being subscribed. And also, if you want to support the channel on Patreon, you can do that. That's a pinned comment down there. You also get to see the moves I'm making within 24 hours, and you get to see the moves I'm ever making in the Patreon portfolio, which is through Fidelity Investments there. And if you want to join us in the Discord chat in there, join us in there. Say hello. Appreciate y'all. Much love as always. If you want to apply for my private stock group, private wealth group, that's in the description. Peace.